So this week, the complete guide to bond markets. Now, this is something which we've talked about quite a lot on the podcast in various guises, because it always comes up in one way or another. Normally when we're talking about money creation and government money creation. Now, we do know, for example, that a lot of money that is created in reality comes from loans from commercial banks, way more than money that is created by the government, because governments tend to cover off, well, not tend to, always cover off their deficits by the issuance of bonds. So how does that work exactly? I've also talked about bond vigilantes, which Steve has frowned about and said they don't exist. So I want to explore that as well on the podcast today. And all of this stems from a voice message. So let's have a listen to it from Mark Slater. He is a Green Party politician who said he really wants to understand how the bond markets work.
Okay, hi Phil. It's Mark here, Mark Slater. I've got a bit of a cold, so I'm going to struggle through this. But I just wanted to say I'm still a bit confused about some aspects of the UK bond markets, and I get the feeling that you are too a bit. And that when you and Steve talk about them, we always seem to kind of comment on them. It always seems to sort of come in tangentially to some other debate. I mean, I know it's always relevant. But I was listening to the Corbyn's New Party episode again, and there's a section in there on bond vigilantes, and I was really interested. But the discussion on 30-year bonds left me a bit confused, and I thought Steve was a bit kind of scornful of you when you were suggesting that the bond vigilantes do have a real influence over the British economy and the way it's perceived, if it's only one in which they are kind of exercising their power and privilege to suggest that maybe the UK economy is not as healthy a place as it should be. So those kinds of issues were really bothering me. And do the interest rates on 30-year bonds bought on the primary markets, do they fluctuate with changes in the base rate over time? I got a bit confused at that point. And I think it's important because I'm trying to I'm a Green Party politician and I'm trying to make a case. And I really want to understand the bond market. So I feel confident when I'm talking about them. So if you could do a sort of a complete guide to the bond markets in a session and just kind of did the A to Z and just went through the whole fucking thing, all the nuances. So I could just kind of go, right, got it now, put that aside and it will stop bugging me, because it's been bugging me for about 2 or 3 years. If you could do that, really appreciate it. Okay, cheers.
So there we are, Steve. Chapter and verse, bonds. That's what we're going to do today. So, first of all, the government issues a deficit, has a deficit, I should say, has to cover it off, because it can't run a deficit within the central bank, which is where it holds its bank account, where the Treasury bank account is. So it has to issue bonds to try and monetize that debt effectively, doesn't it?
No.
Good start. That's what we're going to do today, by the way. I'm going to make lots of statements and you can say yes or no to them, but you have to explain why. Okay.
Yeah, this is why. I mean, I've become a complete addict of double entry bookkeeping, and this is what put Richard Murphy and I on, absolutely the same page. You've got to put the double entry bookkeeping down to know what's actually going on in any monetary system. And this is why double entry booking is used by companies to keep track of whether they're making a profit or a loss. It's double entry is in some ways the fundamental monetary foundation of capitalism is double entry bookkeeping. So when you lay stuff out, in what I use it for is macroeconomic modelling, which is consistent with the actual structure of the monetary system. And when you put the double entry in for the government spending more than it gets back in taxation, then that's something you take a look at the level of the private banking sector, because the government to actually spend puts money in people's bank accounts, to tax takes money out of people's bank accounts. That's the single entry. Where does the double entry turn up? It turns up in what we call reserves for the banks. So if the government spends, it increases the liability banks have, which is deposit accounts. It also increases the asset they have, which we call reserves, which are effectively the bank accounts the private banks have at the central bank. Now, when you look at what the government has at the central bank, so you move from the private bank level to the central bank level, you see the central bank, when the reserves go up, they go up because the Treasury's account goes down. Okay, when the taxation comes in, reserves go down and the Treasury's account goes up.
Right. So all you're saying is this happens. This is what we need to dissect in detail, right? So the government overspends by, I don't know, $100 million, for example. That's, in effect, that would mean their bank account with the central bank would be in the red to the tune of $100 million.
No, the central bank is not in the red. The funny thing is the central bank, when you take a look at how the bond markets operates, the central bank effectively operates like a loanable funds bank, the model that neoclassical economists have in their stupid bloody heads, which they won't get rid of, which they apply to the private banking sector, which is completely false. The private banks create money by creating debt. The neoclassicals don't want to know that, so they pretend the government, the banks just operate as intermediaries between savers and borrowers. Right. In the central bank's case...
By the way, on that, I don't know as most do. But anyway, let's...
Sorry?
I know a few economists. I would say it's widely accepted wisdom these days that most money that's created in the economy is created by commercial banks.
Yeah. You've got to deal with neoclassical economists, mate. I don't recommend it. It's bad for your health, but they simply refuse to admit this.
All I can say is all the economists...
No, they're not dying. The buggers are breeding again. This is one reason I'm doing all these bloody podcasts and YouTube videos and so on.
Okay, but all the economists I talk to about this, right, who are bank economists by and large, all acknowledge, will all say that most money that's created in the economy is created by the issuance of debts by commercial banks.
Yeah, they're sensible people. We're talking academic economists here, okay? These are members of a religious order that want to make sure the people in the pews don't defect to a rival religion,
right?
Or even worse,
maybe
become
today
agnostics.
Then we should discount that, talking about them too much, and actually talk about the reality of what actually happens in the real world.
Okay, so what happens in the real world is that the private banks, when they issue a loan, of course that involves you've got to have a willing borrower as well as a bank willing to lend. So there's a contract negotiation that goes on beforehand. They last as much as 25 seconds, I've been told, if you want to get a mortgage these days. But the bank agrees to give you money to buy a house, say £1 million, and you instantaneously agree to accept the debt of £1 million to the bank itself.
Yeah.
That means the bank's assets rise by $1 million, the bank's liabilities rise by $1 million. Money is fundamentally the liabilities of the banking sector. It's the deposit accounts. So you've created money. And that's extremely straightforward, extremely simple, and conventional economists don't want to know about it. They continue to bring up this bullshit model of loanable funds. But real-world bankers, they'll realise, yes, okay, private banks create money. And once that's created, it's only destroyed when the debt's repaid. But if you have a standard capitalist stays in a capitalist economy, as one person is repaying their debt, another person is taking out more debt, and you get the aggregate level of bonds of debt tends to rise over time. Right. So that's where most of the money comes from. So that's why it's important to think in terms of double entry again, because you can't see these nuances unless you see that there've got to be two entries in every line.
Right. So how does that relate then to a government deficit? So the government deficit. Okay. So the government's got a deficit. It needs to fund that deficit.
Yeah. Well, it doesn't need to fund it. I'll try to start. Huh?
Step by step.
Step by step. Let's start at the level of the private banks, and let's look at private money creation by the private banks. Loans create deposits.
I'd rather not, because we can cover that off. But I'd rather, because we're looking at government money.
Right? I want to just make the difference between the two. Yeah. When you get the loans create deposits things, the asset that rises on the banking sector's ledger is loans. Yeah. When you get the government spending more than it takes back in taxation, the asset that rises on the banking sector's ledger are reserves. Okay, so reserves go up. Then you see how do they go up? You have to look at the next level, which is the central bank, and you see that when the government spends money, there's a negative entry in the Treasury's account at the central bank and a positive entry in the reserve accounts of all the banks at the private banks. So that's why I'm saying the central bank is like a loanable funds operation.
Okay.
One account goes down, which is the Treasury. Reserves go up, which is the...
Okay. Why are reserves going up?
Because that's how money actually gets in your account.
Right.
It's part of the technical process. Like there's billions of these transactions. If you work at the economy,
So you're
the
saying
size
it's because the government spent that money, and so that's how it's...
Well, the government to spend, what has to happen first of all, that there's a law is passed or a law is exercised by a government agency. That law requires, for example, the buying of, I don't know, something like parts for an F-15, the sort of thing a government does to make things better for people in another country, dropping bombs on them. Mm-hmm. So they've got to pay for the M15. They just make it an M15. That's for the soot soldiers rather than the pilots. So to get that rifle built, they've got to send money to the rifle manufacturer. That happens to be a British firm. They're buying, 100,000 of these guns to send to Ukraine or Gaza or whatever. So there's thousands and thousands of those transactions, which are initiated by an act of parliament.
Right. So the government is buying these MI-15s or whatever.
Yeah, and it simply directs that this money is going to be transferred to those accounts.
Right.
And like in the UK's case, the Treasury, the account always starts at zero every day. The Treasury's account at zero. The American account, the practices vary from one country to another. But to increase the reserves at the central bank level, the Treasury account has to go down at the central bank level. So it's a minus for the Treasury and a plus for the reserves for spending. Taxation is
because
the opposite.
the reserves in the manufacturers, because the balance in the manufacturer's bank account has gone up because of the and that's that is counted as the reserves because it's money.
The deposit account of the arms manufacturer has gone up. The balancing item for that is the increase in reserves that the banks have, and it's actually initiated at the central bank level by the Treasury saying, pursuant to the blow the hell out of Gaza Act, which has been passed by the elected Keir Starmer government. We're going to buy a million M15 rifles from some manufacturer in the UK, preferably. So the cost of those million rifles is recorded as a negative at the Treasury's account and a positive at the reserve account of the bank that arms manufacturer deals with, and that means that's how the money turns up in the arms manufacturer's account in the first instance. To have it turn up there, the reserves have to increase.
Right, so how does that happen? So the money goes into their bank account, the deposit account's increased. And I know reserves are not real money, and we're going to explore that as well. But where does that increase in the reserves come from?
There's a huge technical apparatus behind all these transactions I'm summarising at a very aggregate level. But we might remember that Elon Musk was surprised to find 14 what he called magic money computers in the American system when he was stuffing up the American system over there. Those magic money computers are the ones which were authorised to create the money pursuant to an act of parliament. So they said we're going to spend this money. Therefore, there's going to be a transfer of funds from the Treasury account to the arms manufacturer, and to get the money into the arms manufacturer's account, it's got to pass through the reserves of the banking sector in the first instance. So when the reserves go up, that's an obligation on the bank to put that equivalent amount of money in the arms manufacturer's deposit account. So now if you have a continued process where spending exceeds taxation, and they were the only operations affecting the amount of money in the Treasury's account at the central bank, then without doubt at some point it'll go into overdraft. Okay? Now, if you don't want it to go into overdraft, then you have to have another positive inflow into it, and that's where bonds come in. So the bond sales most governments have passed laws requiring that their treasuries do not go into overdraft. So the bond issues are then, when the bonds are sold, they're sold via the central bank itself through auctions the central bank manages, and the bids that
Or through the Treasury, actually.
well, it depends again which country you're looking at here.
Okay, so for the UK, it's the Government Debt Office, which is part of the Treasury.
Okay, yeah. And there's I think the New York Fed handles them for the American system, so it can institutionally Converge actually runs the auctions. But what those auctions do is people then make bids using the funds that are in the reserve accounts. So there's then a transfer from reserves into the government's account, and that's what ensures that the government account can avoid going into overdraft. So the English do it in such a way they manage it on a daily basis. The Treasury's account always starts at zero, but all the mechanics that exist there enable it to go into overdraft during the day and then settle by the end of the day, so it's back to a zero balance again. That's covered very well by that paper by Josh Ryan Collins and friends from UCL, the self-financing state. So the role of bond sales is to avoid the Treasury's account going into overdraft. If the bond sales weren't made, then the account would be negative, but you would still have money creation occurring. The bonds are not essential for money creation.
No. So when banks buy those bonds, I mean, it's not just from reserves. And some people say it's a negligible amount of bonds that are bought by banks through reserves. I mean, there's other ways banks will buy bonds. So they'll buy it from their own retained earnings, for example. In other words, the bank's profits. They, I get, and they have to have some liquidity. They can't basically sell use all of their reserves to buy bonds. So maybe we need to talk about why reserves exist in the first place. Because it's almost like I mean, if you look at how money's accounted for, it's sort of like it's a different supply of money, isn't it? When we look at M1, M2, M3, etc. We're not counting reserves because that's not real money circulating. It's almost like it could be a separate currency in a way, because it's just the interchange between banks, how they move money between each other to settle differences, in effect.
And how reserves are created in the first instance. Yeah, this is something which, if you spend as long working in monetary analysis as I have of monetary theory, when you first find that M0, which is what reserves are called, is not included in M1, it seems weird, because M2 includes M1 and M3 includes M2 and M1 and M4 includes 1, 2, 3 and so on, when you turn to different definitions of the quantity of money. But M0 is not included. Now, the reason for that is it's not part of the money supply, because M0, as it's called, reserves are things which the banks have as an asset, which they cannot use for anything except a very limited number of operations. One is to buy bonds, okay, and the other is for interbank transfers. That's fundamentally what they can use reserves for. Well, before the 1920s, the banks used to be allowed to buy shares with those with those reserves. So a huge part of the stock market bubble of the 1920s was the banks actually buying corporate shares, which was great when the shares were going up and catastrophic when they fell, which is why the Glass-Steagall Act was passed to stop them doing that. So you can only use reserves fundamentally for interbank transfers or to buy bonds. And then that's where the demand in the what's called the primary market, and it's very important to realize there's a primary and a secondary market for bonds. So most people confuse the two. They think the government's actually getting money in return for the bond sales. No, it's not getting. It doesn't actually create any money at all, the bond sales themselves.
Right. Well, okay. So no, it doesn't. So let's take a side. By the way, it's not all bank reserves, and there are other institutions that can buy through primary auctions.
Yeah.
It doesn't have to be banks. So it can be large pension funds, for example, can buy in primary auctions. It's not just the banking sector. So some of that is bonds which are being bought by money which is out in the real economy. So it's not. I
separate that out when I do doing an aggregate macro analysis. But fundamentally, most of the reserves, it would be possible to have only banks being able to buy the reserves, buy the bonds at the primary auction. But people who don't know who don't understand the macroeconomic consequences of that let non-banks purchase in those rounds as well, the pension funds and so on, once they're approved.
Okay. Look, we're going to take a quick break. When we come back, let's just figure out why those reserves exist, how they work, and then let's spend the rest of the time talking about bonds, which is what we're supposed to be explaining. We're just demonstrating, aren't we, how it's all intertwined, and it's quite...
Yeah, it's a mess you can only untangle using double entry bookkeeping.
Right. Okay. Back in a second. So we are looking at bonds, but we are talking about reserves right now. We will get back to it in just a second. So the reason why reserves exist, say I put $100 into my bank account, and you can explain very quickly in double entry bookkeeping that or actually say I borrow £100. Let's do it that way. I borrow £100 from my bank. The bank is in effect creating new money at that stage, and it's also adding £100 to its reserve account at the same time.
When you make a deposit of cash, which is a government liability.
Right. Okay. So what happens to when it creates? What happens to the reserves when it creates that $100 for that loan?
Oh, nothing.
Right.
Okay. The loans are independent. If you then say, I'm going to take that loan out in cash, like, you've got a loan, you've now got a deposit in a positive deposit account entry, you say you want to get cash instead, you then take that 100 out, you reduce the liability of the bank to you because you've now taken cash out. That reduces the vault cash, which is part of the reserves of the bank itself. So, but I think people often, because textbooks drum this garbage into people's brains that the money multiplier model, everybody comes back and imagines the depositor putting money into a bank account as the way in which reserves are created. But for that to happen in the first instance, the government has to have created paper money. So it's still the government creation system. When you look at what can create reserves from ab initio with no previous cash created being deposited or that sort of thing, it's government spending. If the government spends more than it takes back in taxation, it adds to reserves as well as adding to deposits. So reserves are created by the government deficit.
So if I put £100 into the bank, that adds £100 of reserves. But where did that £100 come from? If that is an additional £100,
well, you had cash. Okay, cash is at some previous time. I mean, the government's printing cash.
Well, no, if it wasn't
all
cash,
the time.
I just transfer £100. So
well, that's not going to. That's going to mean that there's going to be a transfer at the level of the central bank between the reserve accounts of the bank. So
no change to the reserves.
No change to the reserves.
Total.
One said one bank's reserves goes down, other bank's reserves go up.
Is why
when you want to create them.
Yeah. So when I get a loan of £100, that might be new money, and it's not adding to the reserves. But when I spend that £100 with a different bank, that bank has to shift £100 of its reserves to that other bank.
Yeah.
So a bank can't issue loans willy-nilly without having the reserve.
No, it can issue willy-nilly, and they do issue willy-nilly. And the last big willy-nilly was called the global financial crisis. Right. Let's get out of this, any bullshit that they are restrained by the amount of cash they've got.
Or the reserves they've got.
So reserves they've got. Forget it. Yeah. I remember actually one stage Krugman, when he was having an argument with me back in 2012, made a comment that banks have to be constrained because lending by their reserves because they can start running out of cash, and therefore when they start running out of cash in their auto banks, they're going to tell the lenders, the lending staff, to lend more. So give me a fucking break.
Right, but
I'd love to be the cash management person who went onto the loans desk telling them to stop lending. You'd be ducking. They'd be throwing computer monitors at you until you get the fuck off our floor.
But I've got $1 million in reserves, and someone comes along and says, "I want to take out a £2 million loan."
Fine, go ahead. You've got 28. For a start, there are no required reserves anymore.
Right, but then if I spend that £2 million with another bank, how do you cover off the reserves paying that $2 million to the other bank? when you've only got $1 million in reserve.
And what will often frequently happen is if the bank is going to run too long, if it's going to have negative reserves as a result of your spending, which is possible, but not at the moment because they've flooded reserves after QE. But back in the days of minimal reserve cover, yes, it's possible they might have in the negative situation. And what will happen is at the bank level, and my father used to do this, so I'm talking from family experience here. He was the Commonwealth Bank's representative on the account settlement system for the Australian banking system. They'd borrow the money back from the bank. Okay,
from the central bank.
If you're going to you literally, and you do the transaction.
You borrow back from the bank that you've just given the reserves
yes,
to. Right.
Yes,
okay.
Because it's a nice little loan for both of you.
So they don't know what to do with.
Yeah, well, they're going to get extra reserves they don't want. They lend them back to you. You've got your cover. They charge you a minimal interest rate, which is the one set by the rules of the central bank. So often those transfers don't even occur. Okay, it's the overall when I model at the macro level, I presume the transfers occur, but what you find in terms of the practices of banks, they'll often end up in making a transfer and borrowing back what they've transferred in reserves and paying a small charge for it because they're still making a profit on the loan they gave to you in the first instance, which is charged at a higher rate of interest than is charged on reserve transfers or reserve loans. So it's a very, very complicated set of mechanisms, but at the aggregate level, most of those things wash out. And if you want to use double entry bookkeeping as the foundation of macroeconomic modelling, which is what I do, then all that stuff just disappears in the wash.
Right. But the amount of reserves, it moves between banks. It's a set amount, the amount of reserves. Unless so reserves increase. You say the reserves are only increasing if money is coming from elsewhere, which is when people are
not elsewhere, from the government.
Well, yeah, I was going to say people putting money into bank accounts with money that they've been given by the government because it's come from outside the private sector. So if you didn't,
it's a non-private sector. Yeah, the private sector doesn't create reserves. Yeah. Okay, you can.
Okay, so the only way reserves are created, additional reserves are created, the government spends money which goes into people's bank accounts, which is new money, and therefore that's matched with new reserves.
Yeah. I mean, you can increase the amount of reserves by selling bonds. So there's all sorts of ways there are shuffles between different accounts. So right. if a bank sells bonds to a non-bank, then it's going to get if it buys them from a non-bank, then it's going to get reserves increasing and deposits increasing when it does that. I mean, even there, I think I made a little mistake. I've compounded two transactions into one. But the fundamental way that you're going to create reserves is by the government running a deficit. And then there's such a stock of outstanding government bonds in existence, and they can vary that amount by manipulating, buying and selling the amount of bonds. So if you buy bonds, you're going to be driving reserves up, sell bonds, you're going to be driving reserves down. All these sorts of things vary the level, but the creation act is the government running a deficit.
So you reckon, so the government issues bonds because it has to, because it can't, in effect, have a negative bank balance with the...
Because it's required to by laws, yeah.
So you're saying they don't need to, but if it just happens that that's the law. So they issue these bonds, and the bonds are sold at auction. We're saying that they're bought by commercial banks. They are bought by these days by a wider range. So if it's bought by a pension fund, for example, the pension fund is taking money that it has, real money that it has sitting in the economy that it's using to buy government bonds. So no new money is being created in that process.
In fact, money is being destroyed.
Yeah.
Okay, because to buy the bonds, what you do is if you're buying the bonds off the banks, then the banks are going to have bonds, which will be valued at their monetary value at the moment. If a bank sells those bonds to a non-bank, then it has a negative against that asset, then the monetary value of its bonds falls. That's matched by a negative for its deposit account. The deposit account of the pension fund falls by the amount of the purchase. That's what happens at the bank level. Then when you look at the level of the pension fund's deposit account has gone down, which is one of its assets. Its holding of bonds has gone up, which is another asset. So for the pension fund, it's an asset swap to buy those bonds. The amount of cash it's got goes down in the deposit account. Amount of bonds it gets goes up, and that action actually destroys money, which has been created by the deficit in the first place.
So the bank can buy bonds. I've said not just from reserves. It can use its retained earnings. It's got, whatever cash it's got. It could do a repo from another bank or whatever it wants to do to invest in bonds if it believes it's a good investment. But I think your point is they've got all this money sitting in reserves, and the world is awash with reserves that is earning nothing for the bank. It's just there as the liquidity for the banking sector. In effect, it's the lubricant, isn't it? Really, for the banking engine.
Yeah, it's liquidity without an income. Well, before the global financial crisis, no interest was paid on reserves.
Yeah.
Now they're paying on reserves because they created such a volume of excess reserves for the banks via QE. Because then with quantitative easing, rather than selling bonds to the banks and to the non-bank financial sector, they're buying bonds off them, and that therefore means the bond holdings held by the pension funds and banks goes down, and therefore the reserves go up in the case of just a bank buying the purchase. When it's a non-bank buying the purchase, then the deposit account goes up and the reserve account goes up at the same time. So again, this is why that's why I invented Ravel, so I could follow all this stuff properly on double entry bookkeeping. It's much harder to say it verbally, and that's one reason. If anybody wants to argue about this, for God's sake, get yourself a copy of Ravel and see if you can prove what you're saying using double entry. It's irritating as hell to me that I get people arguing this stuff, and they're clearly making double entry bookkeeping errors because they can't even see the double entry in their heads.
Right. But it's useful to be able to describe without all of that as well for the pub conversation where you don't want to get your laptop out and explain how the software works. So, but anyway, you're awash with reserves for whatever reason. So you say, well, okay, we're going to use that to buy bonds. So if this, but the banks therefore are competing against these other purchasers. We probably don't want the private sector to buy too many of them because, as you say, it's destroying money unless we believe there's too much money in circulation.
Well, this is actually one of the reasons why the majority of money is created by the private sector rather than the government, because the private sector, when it creates money by creating a loan, the only way you can really reduce that over time is by people paying the debt off, and therefore, if you have a period of time when the aggregate level of private debt's expanding, then you're getting loans rising and deposits rising at the same time, and that asset stays there. Okay? You do have banks do bundle up bonds and sell them as bundle up debt and sell them as bonds and stuff like that as well, but it's nowhere near as organised and as voluminous as the secondary market for bonds, because with the primary auction, as you said, many organisations get involved in there, but fundamentally, when you look at it as part of the macroeconomy, separate out the sales of bonds to banks to the sales of bonds to non-banks. The action of selling bonds transfers funds from reserves to bonds and is an asset swap for the banks, which they benefit out of, but it doesn't affect the money supply. Then when there's secondary sales, and I know that, as you're saying, they're mixed up with primary sales because pension funds and other non-banks can bid in the auctions given the rules.
There's quite a
hedge fund as well. Yeah. But that's the first operation. The money creation is by the government spending more than it gets back in taxation.
Yeah.
The bond sales to banks then change the asset backing that newly created money from non-income earning reserves to income earning bonds, which is why the banks will always fully subscribe to a primary auction, or it will be fully subscribed. It's the secondary auction, the secondary sales, where the sales made outside the banking sector, that reverses the government money creation.
Yeah.
And given the volume of it that's allowed these days, 100% or more is allowed to be sold of any issue.
So why do banks sell? Why would if they've
because they're making a trading profit.
Right.
Okay.
Okay,
They're gambling.
We'll come on to that.
This is where the bond market turns up.
Yeah.
Ups and downs, and
we will come on to that because there's been lots of that lately. So but where we are right now, the government spends, money goes into the economy, They pay for the rifle manufacturer. It adds to the aggregate deposits, reserves, I should say, which adds to the aggregate reserves which are sitting in banks. Banks can use those extra reserves to buy up bonds to cover the money that's been issued by the government, the deficit that's been issued by the government. That's in effect how it's working, isn't it?
Yeah. And then the banks then trade that on the secondary market. You get the huge scale of the bond market, buying and selling, gambling about rising or falling bond prices. There's enormous maturity management that has to be done as well, and glossing over all of that, of course.
Yeah. But that's an important part of it, because the price that is those bonds are sold for obviously varies a great deal. And everyone, the banks will be looking at two things. Like anyone buying bonds, they'll be looking at two things. They'll be looking at the price they're paying for it now, and sometimes even on the first issuance. In fact, quite a lot lately, they've been selling for below the cover price, the issue price. So a $100 bond might be going for $96, for example. So you go, well, that's cool, because two things happen there. One is we'll get because the coupon rate is announced at the auction. So you might say, let's keep it easy and say it's 10%. So we're going to issue a $100 bond. We're going to give you $10 a month for every year on that.
Every $10 a year, yeah.
And but it only sells for $90. You're still getting your $10. So the yield is higher.
We've got a higher yield.
You've got the capital gain if you manage to sell it down the track for $100. If you wait right to the very end, you'll get $100.
Then it's going to be worth $100. Yeah,
inflation will have whittled it away, of course. So that's another factor. So we have that issue, and then those yields are determined, and the price that people are prepared to pay depends on the length of the bond, which could be 6 months, could be a year, could be 2 years, could be 5 years, could be 10 years, could be 30 years. Even some countries now issuing 50-year bonds, and obviously the yield differentiates based on the length of time that you're going to hang on to it, but also on what the central bank is doing and how the economy is going as well. So all of these factors determine what price is going to be paid for those bonds. And I talked about bond vigilantes, and you said, there's no such thing. But there are groups of people, large institutions, for example, who say, the government's running a big deficit. I mean, rightly or wrongly, they're going to say, because I understand your point. It's crazy to say, well, the government's running a big deficit, therefore there's going to be more bonds issued, and therefore there's going to be less demand. Because I know your counter to that would be, if the government's running a large deficit, they're going to be spending more, therefore there's going to be so much more reserves to be able to buy up those bonds. They're going to level themselves out. And yet the psychology of it all, which is important when we're talking about, it all gets down to financial markets, all get down to psychology. And it's more psychology than
cocaine.
And cocaine, exactly. They snort too much. And they think, well, okay, don't like the idea of the way the government's behaving, therefore I'm going to penalise them, so I'm not going to pay the full price. I'm going to pay below par for those bonds. And that's been happening a fair bit lately. Because people don't like what the government's doing.
I mean, this is secondary market activity.
No, and primary markets as well. Primary markets aren't.
Yeah, well, you get competitive bids and non-competitive bids, and, the amount that's actually sold at, there is haggling, no doubt about it. Okay, and the haggling is affected by what's going on in the secondary market. But the capacity of the government to dominate that is ridiculous, and this is why the primary market is so different to the secondary market. Because if the government, the whole idea is that there will not be sufficient willingness by bond buyers to buy the bonds issued by the government to cover its deficit when that deficit is too large according to the market. Okay, that's the sort of attitude. Well, I think I just worked out recently that the quantity of outstanding bonds in the UK right now is equivalent to 30% of GDP. I think that's right. And the deficit is never more than, say, about 10% of GDP. We're going to get exceptional events like COVID and the global financial crisis where it's larger. But on average, you're going to see less than 10% of GDP being the scale of the deficit. Now, and their reserves, they pay interest on reserves now, but it's a lower rate of interest than you pay on bonds. So and the number of auctions that occur in the UK is about 100 auctions a year. America has over 300. It's more than I think it's more than one auction per day in the USA. But it works out with the UK that the average, even if you're running a 10% of GDP deficit, which is large, then the average volume of auctions in any particular auction is 0.1% worth of GDP, when the volume of outstanding bonds is 30% of GDP. That's 300 times the amount of funds that are necessary to buy a new issue of bonds. So if you had the bond vigilantes say, "Oh no, we're not going to pay that price. We're not going to give you that much on the yield. We're going to want a lower price for your bonds, so we get a higher yield." The Treasury, the central banks say, "Oh, okay, we're going to buy all the outstanding bonds, 30% of GDP, buy them tomorrow," which they can easily do.
But they never do. But they wouldn't.
They never do. They don't need to, okay? Because the possibility for the government doing that is so powerful that, and the privilege of being involved in primary auctions is so lucrative and such a status symbol as well for banks, that they haggle. You get a bit of variation in the actual price. The secondary market price will, to some extent, affect what's offered in the primary market. But the government could be an arsehole about it. I'd be happy to take the role of chief arsehole in this particular position and say, okay, if you don't like that rate, we're going to drop the rate by 50%. We're going to give you, a 2% yield rather than a 4% yield. We're going to buy all the existing bonds off you. We're going to reduce the amount of interest you pay you on reserves. What are you going to do?
So people would
the
say,
government doesn't
I tell you
have to
what you do. Most people would actually say, well, I'm worried now about the integrity of the British government and the British financial system. I'm just going to buy bonds overseas because I'm worried about the.
That's again the secondary market.
Yeah.
If you want to be in the primary market, you've got to, you've got
buy.
legal requirements to purchase. So the market makers and so on. There's again the legal structure and the status involved. You will. The main thing is the sheer volume now of outstanding bonds, which the central bank could simply buy what I'd show in macroeconomic terms as a one-line transaction. We're going to buy 30% with GDP worth of bonds. That's going to give you reserves of 30% of GDP. We're going to cut the rate on reserves to zero. We're going to offer you 2% on the bonds. Do you want to put up with getting zero, or would you prefer to get 2%? So the bargaining power of the central bank in this situation is enormous if they're willing to recognise that they have that power in the first place.
So is it fair to say that the whole process of the government running deficits and putting money into the private sector, which turns up as increased reserves, which then is covered off by bond issuance, which we know is a sizable amount of GDP, but not necessarily adding much to the money supply, because we know most of the money supply actually is being, because it may be created, it may create money when from commercial banks, but a lot of it is sold on the secondary market and then gets destroyed. But the whole process through all of that is that reserves have increased, and so that is definitely happening, even if the amount of new money created in the process is marginal, because most of the money that's been created is by commercial banks issuing loans, and they are more comfortable issuing more loans if they've got bigger reserves. I mean, there's very little constraint on, because there's a bigger loans as a whole can be issued because there's bigger reserves to cover it as a whole.
It's like going pour lubricating oil in your engine. You put on 50 times as much as necessary, you probably won't get less friction. But it's a bit of a waste.
It's certainly not going to dry up anyway, is it?
Yeah.
So governments are issuing government debt or government deficits, I should say, are increasing the supply of reserves, probably not adding a great deal to the amount of money that's being added to the economy, but bank loans are. And that's where we are right now. Whether it's right or wrong, is that a pretty good summation of,
Pretty good summary. And I think this is the thing which is so annoying about the average comic correspondent on this on Twitter and social media and newspapers and even government itself. It exaggerates the importance of government debt, and it government money creation and ignores private sector money creation. When you take a look at the numbers, this is what Richard Vague did so well recently with the United States numbers, you find that the vast majority of money is created by the private banks, not by the government. So if you're worried about inflation, control the private banks to stop fussing about the government. The government's trivial and in the current system, and that's what's ignored.
And that whole process involving bonds and bond issuance and all the complexity of the way that the bond markets operate, I mean, it's very complicated for very little gain, dare I say. I mean, it becomes a vehicle for investors, and it's complicated. And so the complexity enables people to make money on it by, getting capital gains by buying when prices are lower on the primary or secondary markets. It just becomes another asset class that can be traded on.
It's another speculative vehicle, and we've got an economy dominated by speculation, and we wonder why it doesn't perform all that well.
Yeah, but in terms of the good that they're doing to the economy, nothing.
Yeah, you're taking, and that one, I would, having watched this for the last 30 or 40 years and seeing how the paranoia over bonds paralyzes sensible government policy and means that far too much money is private credit created rather than government fiat created, I'd be in favour of saying, look, I'll let the central bank buy the bonds, period. And then if the central bank buys the bonds in the primary auction or whatever else, then the banks will just have reserves. We'd pay them a bit of interest on the reserves to reflect the cost of managing the payment system. But basically, let's reduce the scale of the bond market. This is Frankenstein's monster.
Okay.
And it's time we tamed it.
Okay, so final question then, or final point. Rightly or wrongly, I mean, you talk to modern monetary theorists and they will say, well, I'm not describing what should be, I'm describing what already happens, seems to be their argument, that the government creates money. But we've just said it's not really. It's creating reserves. It's not really creating very much money at all.
Well, it creates money when it reduces the deficit. Okay, the trouble is the machinations of the bond market, particularly the secondary bond market, selling bonds from banks to non-banks, that destroys the money creation done by the government. There's no comparable operation in the private money system that destroys private money creation. So we have money being created by the private sector by increasing loans, but not destroyed normally. With the government, we have it creating money by running a deficit and then destroying that by enabling the bonds to be sold to non-banks. It destroys the money elsewhere than where the money is spent. So back to our arms manufacturer, the government spending creates the profits for the arms manufacturer. But the overall economy, the money is taken out by the financial sector, buying those bonds off the banks in the secondary market, right. And that reduces the amount of money in existence, but it then gives the bond holders an income stream from money created by the government to pay interest on bonds.
So for modern monetary theory to work for the way MMTers would like, the only way for that to work really in reality would be for the government to say, okay, well, we'll go through the whole bond issuance process. Commercial banks can buy it with because they've got more reserves now because we've pushed up the amount of reserves because we've put money into people's bank accounts. And we are going to limit how much is sold on the secondary market because that is what's destroying the money supply.
Yeah, that's my memory from being a child and learning economics in year 11 at school was that the requirement then was in this Australian system, the banks had to hang on to 28% of their capital had to be in form of LGS, local and government securities. And we saw that as a way of financing government operations back in those days. What I realise now is it meant that at least 28% of the money created by the government remained in existence. But now,
do you think we were wise to it in those days?
Sorry?
Do you think that was the reason why? Were we wise to it in those days? Were we smart enough to?
No, I mean, there are elements of wisdom, and you can find them after World War II in particular. So like one of my favourite papers by Beardsley Rummel, and I mentioned it in a forthcoming YouTube video, is called Taxes for Spending Are Obsolete. And what he realised from the experience of World War II, and the New York Fed was mainly involved in the financing of that of that effort and the sale of bonds, which didn't finance it but took spending power away from the private sector, he realised that we don't need taxation. Taxation doesn't fund government spending. Government spending funds government spending, and taxation reduces the amount of money created. And he saw the bonds were irrelevant. That was all well and truly understood after World War II. Within a decade, neoclassical economists had poisoned the thinking so much that people began to see those bond sales as being critical for financing government operations and seeing taxation as financing government spending rather than reducing the amount of money created by government spending. So we used to understand this. We've lost it again, and I'm seeing it happen right now, losing the knowledge of all this after the global financial crisis. Since now that it's 18 years since the crisis began, we've now got children entering universities who were not even born when the crisis occurred, and they're being taught by economists who don't admit they didn't see the crisis coming. So you get more and more confusion coming out, and you know.
Well, hopefully we've explained to Mark a bit more.
I hope so, a bit.
Hopefully most people followed through all of I think we covered off a lot of ground today. Look, next week, what if we didn't have reserves at all? What if we had sovereign money or 100% money? Are these principles that could work? Or is it a step backwards? We'll look at that next week on the Debunking Economics podcast. Thanks, Steve.
I'll brace myself. Okay.